Craig's a tax partner with Cause Chambers Westgarth. He advises ASX and public clients on a variety of tax issues, including managing input tax credit entitlements and large-scale M&A activity, demergers, IPOs, capital raisings, corporate restructures, and property, infrastructure and finance transactions. And our second presenter is Matthew Nicholls. Matthew's an executive director with Ernst & Young, and he's a GST specialist. Prior to joining EY, he was employed by the ATO for more than 14 years and has extensive experience in providing advice on technical and procedural issues from what he calls both sides of the fence. Matthew specialises in advising and assisting clients with transactions from a GST perspective, providing advice, maximising GST opportunities and evaluating and minimising GST risks for clients. Matthew's also a member of the Tax Institute's GST subcommittee and also the SA technical committee. So I'll hand over to Matthew and Craig. They encourage participation. Obviously this is a breakout session, so we encourage you to interact with each other and the presenters. There should be some materials hopefully that the last session left on the table for you to use as we go along. Thank you.
Okay, thank you, Craig. Look, hopefully you guys have chosen to attend the best session because Craig and I have now practiced our session once, so we should be a little bit more polished this time round, we hope. Now, what we're going to do today is, first of all, give you a little bit of a summary of some of the recent changes that have come out, in particular some of the guide that's been released and also the recent determination on facilitation. We're also going to base most of our discussion around 6 case studies, which hopefully will help tease out some of the issues that you may encounter during M&A transactions. And the examples are all structured a little bit differently, so we'll see how we go. So first of all, just a slide explaining what we're going to cover broadly today. The rules of IT entitlement in a M&A. We're going to explain recent changes. We're going to do 6 case studies, and we're going to provide guidance on strategies for managing input tax credit entitlements during an M&A or during that type of transaction. The particular things that we will focus on there are, hang on, I think might have missed a page. Something went wrong there. There we are. Introduction to basic principles. Then we're going to spend a little bit of time on issues that create uncertainty during an M&A transaction. We'll then do a case study. We'll just take a look at how some of the recent changes may now impact the Belvedere case as it was expressed back in the original example before the ATO chose to change it. Then we will go on to to other complexities in M&A, being facilitation, Division 72 and Division 84. Craig, you're going to make your comment about whether or not people are awake today?
I think I'm not awake today. Of course, we're just testing you by flipping around those division references to the actual to the category to which they apply. The 72 and 84 should be transposed. I'm glad some of you picked it up.
So that was your little wake-up call. Now there'll be more tests as we go through today's presentation, so you will have to pay close attention. Then again, I could be making that up. So as you can see, there's a different summary of the different examples that we'll go through, and then finally we'll have a little bit of a discussion around approaches to ITC determination and recovery strategies that you can put in place perhaps to improve your positions. So we'll start off with the fundamentals. The fundamental is, obviously, you can only claim an input tax credit where you make an acquisition for a creditable purpose. The creditable purpose test carries there are two main tests that impact you in an M&A transaction. The first one is whether or not you actually acquire the acquisition for use in carrying on your enterprise. In our example here, we're going to mainly assume that you pass through that test. The second point is that you are not entitled to the credit to the extent the acquisition relates to making input tax or supplies that would be input taxed. And this has been the area of contention for some time in its actual application. Just as a bit of a background there, there's some rulings that do provide ATO guidance. There are a whole heap of rulings if you really